Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. Today, very special guest coming back on the show, Mr. David Belle, aka the Grim Reaper, ladies and gentlemen. Thanks a lot for coming on, David.
Hello, mate. No worries. Thanks for having me again.
No,
Always like to chat to you.
it's an absolute pleasure. The pleasure's all mine. And, it's very time sensitive having you on at the moment, given everything that's going on the macro. We live in this kind of crypto bubble, which has now got very, very exposed to everything going on elsewhere. And we had the FOMC on Wednesday, and we've had a number of market-moving events that have really revealed a lot of things going on and really highlighted just how tethered to really the Fed and their interest rate hikes and everything else going on around the world. So that's why I thought we'd have you back on just to chat about everything and really, maybe give us some direction of where you think these markets are going. I mean, I'm sure people have an idea that follow you on Twitter, but maybe extend on that during this interview.
Yeah, no, absolutely. I think I've maintained for months now that the base case, when it started to get signaled back in September, I think now, the base case for all of your thesis in terms of directional play, in terms of how assets sectors are going to sort of shift and change, should be that the Fed's looking to tighten. And I think this week pretty much proved that. We had that initial spike up. Do you know what? I'll share my screen here.
Perfect.
We had the initial spike up, the ES across all risk assets pretty much. Let me just make this one bigger as well. I don't even know how to do that, so I can see your beautiful face more. No, I don't know how to do it, but can you see my screen there?
Yes, I've got your screen.
Yeah. Okay, cool. So yeah, we had this initial spike up right after the FOMC, and it was just more of an order flow and order dynamic thing. It had been heavily shorted. 50 basis points was in line or slightly better than what the market was expecting. There was basically no surprise, is how to put it. So when there's no surprise in financial markets, then things tend to reverse and go the other way, especially when things are very, very pessimistic. But then you come to the next day and people realize there's nothing dovish about a hike. Dovish is when you're softer on inflation, basically. There's nothing dovish about interest rates going up. And then obviously we got the big fall yesterday. Again, though, I've said today that I don't see why we couldn't rally all the way back up here, and this is with regards to the ES, so the S&P 500 E-mini contract, all the way up to maybe 43.50, 43.80 into the next FOMC, which is in June. So, about a month from now. Purely because the market likes to chop people up and fuck people over like that. So that's why I think that there's the possibility. And if you look at the structure here, these are three really, really clean highs. Probably quite a few people are selling, here, probably people selling here. So all of that can act as kind of a propellant to the upside if we do get some sort of good news, some better data. Equally, however, we've got the NFP today. And I think if that comes out really strong, surprisingly, then we go this way.
And
we go down that way.
And the NFP, for people who aren't familiar, is the non-farm data payroll. So it's the labour market that they're looking at today. Is that correct?
Yeah. So the amount of people employed, basically. So the amount of jobs added over the last month always comes out on the first Friday of the month. And, you'd expect that good data equals markets to go up, but not in this case, because it solidifies the fact that the Fed needs to hike. Powell was mentioning the tight labor market. If we get jobs in line or jobs above the expected number, we go down here. We start hitting 4K on the ES for Bitcoin.
So that's interesting. So you think actually on good data today, if we get a good data reveal, that's actually going to be negative for markets?
Well, yeah, because one of the issues right now is that we do have a tight labor market according to the data. Now, in reality, that might not be the case.
Yeah.
And there's various reasons for that. I saw an anecdote of someone who said the corporation that they work for is advertising, like they've got 10,000 job ads for like 10 roles, something like that, and they've got it across multiple job boards.
Wow.
And so there's a measure called JOLTS, and I think TradingView has it. I'll get onto Bitcoin after. No, maybe we don't have it. Here we go. No, we do.
There we are.
If we go to total non-farm, look, record amount of job openings. Now, this doesn't necessarily make sense. You know, it doesn't really make sense. And one of the things that I think is happening now is that with this whole advent of working from home, remote work that we've sort of developed over the last 2 years, I think employers are going really, really heavy on online advertising of jobs. And so these are being counted in when really the amount of jobs that are open are in fact, you know, 10% of the amount of job ads out there. So it might be messing with the figure, but in terms of the non-farm payrolls number, yeah, the Fed needs a less tight labor market. They actually need unemployment at the moment because it means that wages can come down.
What an interesting predicament. I mean, you know, markets are very sensitive to all these data points, and we've got the CPI coming out. I think that's on the 10th of this month. What's your sort of bias for that? Do you think that needs to, because ultimately I think if it comes out high, we're going to see, even though it's totally contradictory to why Bitcoin was created, this huge inflation hedge and everything like that, markets I think are going to slide off on the back of a higher CPI number. What are your thoughts on that?
Yeah, absolutely. It just gives more sort of viability for the Fed to hike. And you might see that if the inflation number is very high, based off of what Powell has said in the last couple of months, you know, he was at the Finance and Banking Committee at the Senate, and in a response to Senator Shelby, I might have mentioned this last time as well.
I think so.
Powell basically, you know, provided his admiration for Paul Volcker, who induced recessions to contain inflation. And he basically said that if he needs to do it, then he'll induce a recession. And he'll do that by obviously raising aggressively, raising tightly. So if we do start to see higher CPI, especially at this next meeting, when the market has been pricing in even 75 basis points of hikes, although Powell's had said already that he wouldn't go to 75, you know, the market can defy what Powell is saying. So if the market starts pricing in, and if you look at short-term interest rates, a hike of 75 basis points, that is shit for risk assets. So it's shit for Bitcoin, it's shit for equities, it's shit for growth stocks, it's shit for Apple as well. And I've said already that, and I wrote about this on Sunday for Macrodesiac, that if Apple goes, then the market goes. Because Apple is what I consider, or have considered until rates were going up, a blue chip sovereign bond. So it's an equity that people buy to replace the yield that they can't get on US treasuries, because Apple's yield is higher than the US 10-year treasury yield, for example. So if rates start going up, then that yield on Apple decreases and people no longer want to hold that. And Apple is, you know, the determinant of the market. It's similar to, you know, Tesla, Microsoft, but Apple is the largest concentration in the S&P 500, largest concentration in the NASDAQ. So if Apple goes,
they're all going.
Say goodbye to the market for a while.
I love what you said about Volcker, because one thing that Jerome did, I mean, he even mentioned reading Volcker's autobiography, and I think he took a piece out of it where he said, you know, that Volcker, he didn't want to have to do it, but he did what he had to do. And that's, he's like inflation man now, Jerome Powell. He's very much willing to fight it. And I think CPI is going to be a little bit higher when we top out. I think, you know, there's certainly a lot of people speculating that inflation is starting to peak. But this is the main thing driving markets right now, is your interest rate hiking cycle. Your monetary policy is driving everything. We've gone from March 2020, a very loose monetary policy to say the least, to now tightening. You know, we're at the other end of that, and you can clearly see the huge run up that all markets had from March 2020. We're now at the other side of that, and for me, the risk is to the downside, and I think you're very much in agreement with that.
Absolutely. You know, one thing that people tend to forget, and even macro guys, well, not even, I don't personally. I'm a very basic person. I don't understand half of what they talk about in macro when they get into the intricacies and why X variable should affect another variable and all this bollocks. I feel like it's them just trying to play the research game and trying to make themselves seem a bit smart. But, you know, the base case, when you're looking at things over, you know, longer than a 1 month period, say, is what are central banks doing? Are central banks tightening policy, or are they loosening policy? And that is all that really needs to be in focus. You know, from, as you mentioned, from March 2020, we, you know, went to ultra loose policy and the markets rallied, you know, amidst the shittest situation ever. We had people not working. We had, you know, GDP down. So what does it tell you? It tells you that it doesn't fucking matter what the actual economic numbers are doing. The economic numbers are only there to influence what the Fed is doing, and what the Fed is doing is what the market then responds to. That's all. You know, the reason why we do look at those economic numbers is for exactly that relationship. You know, we're purely trying to identify whether the Fed will, over a certain time frame, hike or loosen policy, and then we either buy or sell. That's as simple as it becomes. Do you know what I mean?
Absolutely. You know, it's so correlated, and you know, it's driving the market. I mean, if Fed go back to, and I think eventually they are going to have to revert. We spoke last time you were on about the reason the Fed is being quite hawkish, or definitely being hawkish at this point in terms of tightening, is to get away from that zero mark, which they're ultimately going to undo at some point. That's going to be good for risk on. That's going to be good for crypto. That's going to be good for everything. But right now, the tone has been set. And I mean, my takeaway, I mean, I was watching it, I was trading it, the FOMC meeting. I mean, that was literally the definition of a relief rally that didn't make much sense. It didn't make much sense why markets were, well, it made total sense from a technical reason why markets actually saw that relief rally. You got a lot of short squeezes, certainly in the cryptocurrency space. But in actual fact, what we saw immediately after was the majority of those gains get undone. And that was because the reality of the situation is still very much at play. You know, it's not gone anywhere. And I actually thought the Fed was very hawkish. I thought they were, I didn't think there was anything unexpected. I think people were looking at that 75 basis point sort of rhetoric that they didn't get. And they kind of had a bit of a sigh of relief when markets were already looking for relief. But that's...
Listen, that was absolutely the key on that initial rally, was because the Fed ruled out 75 basis points. But Powell has ruled out quite a few things so far. You know, I was with him in the terms of believing inflation is transitory, and he did allude to that in terms of the supply chain stuff. And, you know, in theory, I still go with inflation being transitory. However, in practicality, as a policymaker, I don't think you can say that, because you lose credibility. Basically, you have to be seen to be doing something, right? And this is the problem. You know, there's a balancing act between creating a recession and reducing inflation. And you have to kind of think, what is the lesser of two evils? The problem is that the Fed's mandate is to keep price stability, right? That's their central mandate. So they're obviously going to, you know, prioritize tackling inflation over even, you know, creating a recession, because that is all that matters. But, you know, the zero lower bound thing, I wrote about this on, when did I write that? Monday, Sunday, maybe. And yeah, I'd alluded to it here, I think, in terms of the 75 basis points. I do think that they were going to go to 75 basis points in June, even though Powell's ruled it out. I really, really do. Markets, you know, declined its pricing of that, but, you know, I really, really do think that is what they will be looking for.
Wow. And that's when they're planning on essentially reducing the balance sheet as well. I mean, and that's another thing that I'm sure we can talk about, is them looking to actually start to reduce and sell some of the balance sheet. That, to me, instantly is not a good outlook for markets. If they're going to go to 75 basis points when we've already seen a sort of sigh of relief, that become the play again. And then on top of that, they're going to start reducing the balance sheet. I mean, that is not a positive outlook, I don't think, from any stretch of the imagination for markets.
Well, something else to look at as well is the zero lower bound, as we mentioned, because I think that if you are stuck at that that lower level, and this is mainly what I wrote about, was the effects of being stuck at the zero lower bound and how it induces bad investment into the economy. It induces unproductivity. It's all in this article here. But basically, they need room to get away and cut when things do go south. So this is why I'm pricing in real aggressiveness, and I think, the fact that Powell is so hawkish now, he has said that he's willing to induce recession. I wouldn't put it out of any kind of realms of possibility that they go 75 in June. Whether I necessarily think that they will do that, and I just said that I think they will go 75 basis points. What I meant was I wouldn't be surprised if they went 75. I think there's, let me say that I'm 60% 50 basis points camp, 40% in 75, even though the market's not priced in 75, if that makes sense. I think that there's the possibility there. But then again, I guess with quantitative tightening, where they're looking to sell off the balance sheet, that could contribute to the effects of a 50 basis point hike, almost like equating it to 75, if that makes sense.
So it may make up the extra 25 basis point. I mean, it will have a similar sort of effect. I mean, I'm watching them reducing the balance sheet. Do you think they're going to stick to that and do that?
Oh yeah, absolutely.
Wow. Because and this is the sentiment. I still think, even though cryptos have sold off considerably, your indexes have sold off considerably, everything's sold off considerably, I still think there's more to go. And I think it's linked to everything that we're talking about right now. And I still think there's a lot of people almost in denial. They're still kind of hedging their bets that the Fed don't actually do this after the Fed have kind of had egg on their face for the past 2 years. I think things have got a lot more serious, and they're now at the talking has stopped, and it's now about doing for them. And that's not great.
I think you have to bear in mind, so basically all people have known, most of the new people, is markets going up. They've probably barely seen a bear market. I'll tell you, the worst bear market was 2018, because things just went sideways. I don't mind things going down because there's opportunity there. When things are going down, sideways for a whole year, that is fucking shit. I don't know if you were around in 2017, 2018.
Yeah, I was getting into the crypto space, but not really in markets, so to speak, just speculating on crypto like I think a lot of us were.
Yeah. And do you remember when everything just went sideways for ages? It went down and then sideways for like a year. It was like, what do you call those, tumbleweeds?
Yeah.
Just everywhere for literally a year. It was awful.
Yeah.
And there's parallels there with DeFi and ICOs. Not that they're the same thing, but I mean, they could be relatively equivalent. But there's parallels there with, there was massive hype with ICOs, white papers galore with absolutely no product, fucking stock images taken of a team, and the people probably didn't even exist. It's probably one man in his shed. DeFi is a little bit more complex, I guess, but there are parallels in terms of the hype.
Yep. I also think there's parallels not only with the ICO era and the DeFi era. There's also parallels with, I don't know how into NFTs you are, but the ICO seems to have evolved into DeFi, into NFTs. I mean, I can't tell you, and I'm not going to name anybody on here, how many DeFi projects I know that have one developer and a dream, and that's about it. There's nothing really there. There's nothing new. People, I mean, the first vampire attack we had was, of course, Sushi Swap, where they very much sort of, leached onto what Uniswap were doing and capitalized off it. But people are just very much copying things. And in the NFT space, I can't tell you how many projects there are that I know have got nothing going on, yet they've got all these buzzwords in their white paper like metaverse, all these things that are just never going to get there. And it's just a new real form of ICOs. Don't get me wrong, I think there's some amazing DeFi projects out there. We cover a lot of them on the channel, and some great NFT projects. But I would say the vast majority, and we spoke about this 20% of productivity really booming the rest, carrying the rest. I think there's a lot of projects out there that have nothing going on other than a few buzzwords and sort of capitalizing on people's speculation.
People want to talk about assets being uncorrelated, but if you were to create a matrix of assets and assign them different betas. So how much they move, you know, relative to a benchmark of, let's say, the S&P 500. You'd probably have DeFi at the top, then NFTs, smaller cap cryptos, you know, and then your blue chip cryptos, so Ethereum, Bitcoin. I don't know, maybe you can name 2 or 3 others.
Yeah, things like Sol, Luna, ADA, those sort of things.
Yeah, there you go. And the thing is that if you were to run a matrix on them and maybe, you know, use some coding and whatever and be totally agnostic to what they actually are, all you would find is that they're very, very high beta assets at the end of the day. And a big portion of the reason as to why, you know, those top things are high beta is because there's less liquidity in them. So when rates are being raised, that liquidity drains and you've got really big downside and difficulty of getting out. When rates are nice and low and capital's free flowing, everyone's having a fucking great time, you know, people can remortgage their house, get more capital, you know, all of this kind of stuff, fine, because there's a bid in the market. When a market goes no bid, it's brutal. And that's why you're seeing a lot of NFT stuff just go to, you know, worth 10 quid.
Yeah, and it's all relevant to what we're saying, because this is what we're reckoning that markets are looking like now moving into the future, at least for the immediate, you know, next 3 months or so. They are, it could be possibly longer, or will be longer, I reckon. Liquidity is, that's the whole point of what the Fed's trying to do right now. They're taking they're taking the wind out of market sails, and those bids may not happen anymore. You know, you're going to have people, and we spoke about this a little bit off camera. I don't think things have got as bad as they need to get to start exciting people back into markets. I think there's still quite a bit of downside. And I think a lot of that downside is, have we really seen anybody panic out of markets yet? Have we really seen people go, right, we've got to sell because we've got a mortgage payment or we've got food to get this? You know, it's an environment. The risk is definitely to the downside right now. And when you talk about your higher betas, they could be in big trouble.
Yeah, no, absolutely. And I think one thing that we mentioned off camera was excess savings. And, you know, if we go to this article, this from New York Times, to say, let's hope that it's working. So this article was pandemic era excess savings are dwindling for many. And this is something I was writing about in early 2021, was that, you know, the people, central bankers, politicians, whatever, was saying, oh yeah, people have been able to save money, all of this, pay down debt, blah, 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 pay down credit cards, all of that. Fine. But those first 2 quartiles of income, so the lowest earners and the second 25% of lowest earners up to middle or median income earners, they have the largest marginal propensity to consume. So that means that they actually have a really low savings rate. The money that they do get in tends to be purely on consumption, right? So with prices going up with inflation, all they're going to do is spend all of those excess savings. So those savings for those people have dwindled, okay? They've likely already been wrecked in the markets as well. So now we move over to the next 2 quartiles. So you've got, you know, your slightly above middle income earners and then your richest. These are the 2 who have the most in the markets. So what we could be seeing is, if markets do drop more, is that these people start selling down a portion of their, you know, investments, a portion of their risky assets, and moving into things like bonds. Like if you see the bond market right now, okay, and you have a portfolio of 60-40. I'm long TLT. I'm getting absolutely fucked. I'm long from between 130 to 149. So all the way in this portion. I thought we were going to tick up higher, but yep. I'm very passive in it. You know, I'm very, very passive in it. I don't mind. But yeah, it's getting fucked at the minute, basically.
Absolutely.
But this is what people might see, especially if they're a slightly more experienced investor. You know, people with higher incomes tend to be a little bit more experienced, right? They're going to be looking at this like, fuck, equities are down, but TLT, the easiest way to get into bonds, is all the way down here at a 3-year low. right? They're probably thinking, okay, let me buy bonds now, taking money out of risky assets before they completely collapse, and pushing the bond market higher because they see that bad things are coming, basically. Now, if we look at Apple is the market at the end of the day. Apple's not fallen that far. I was mentioning just earlier in the podcast that Apple is, the most concentrated stock in the market. Considering it's not fallen that far yet, you've got to wonder what is holding it up. And I think those two upper quartiles, people who have been investing passively in SPY, triple Qs, that kind of thing, they're probably holding Apple up right now. And if they start pulling money out of it, considering Apple is the largest stock in those two ETFs, then we start ticking down here. And you'll know that Apple at the moment is trading under its 200 daily moving average.
Yep.
Nothing good happens under the 200 daily moving average. Nothing, ever.
Yep. No, I mean, this is Apple is going to be key to watch moving forwards. And what you mentioned about a lot of the middle to upper class people actually just being passively in indexes. I mean, I can't tell you how many people that I know invest in the UK and they just invest in the FTSE. And
yeah, I mean, the FTSE's good for dividend yields, though. That's the difference. Like, if you just hold a basket of UK stocks for like 30 years, you're actually making all right money, even though the FTSE doesn't go up because you're earning on the dividends.
Do you think that's going to continue moving forwards? Because if you look at the FTSE, it's not that far at all off its highs. Do you think that sort of dividends yielding element of it is what's really holding it at the moment?
Yeah,
it's a tough one
to say. Yeah, I think people in the UK are much more risk averse than in the US. And so they're not necessarily risk averse, let's say conservative, let's call it that. And this is why we see the FTSE just have no tech stocks in it whatsoever. Like, people just don't give a fuck. They're happy just, holding it in their SIP, holding it in their massively diverse fund provided via their jobs. They're not like in the US where they're like, yeah, I'm going to fucking buy a shitload of this small tech stock and it's going to go 100 times or whatever. They're very much happy just having a portfolio of strong dividend companies.
Yep. And when you're talking about Apple, so we are looking at more downside risk. That's your current position right now. Now, that doesn't mean that we can't see rallies, and sometimes the harshest rallies occur in a downtrend, but you're calling this market right now a downtrending market. Yeah,
absolutely. How can you not?
Yep.
You can't not. If you go into S&P 500 futures, it is. That's all it's been doing. You've seen a harsh rally here, for example. We took this low, traded a bit higher, traded, back down roughly to the low, and then traded back up again. There's just nothing there to say don't be short, I guess.
No, I absolutely agree with you. And if your S&P and everything does continue to slide, and Apple is something that you guys, thanks for pointing that out, by the way, because I actually wasn't really watching Apple and equating it to just how much it makes up the NASDAQ and the S&P. But if these continue to slide, that's going to be bad for all risk assets. And this is going to all be driven by the Fed and them doing what they're currently doing. I mean, they are definitely, again, I can't help but feel like people are still in denial. I can't help but people and I often hear people go, no, when you look at, for example, the inversion on the bond yield curve, people are looking at that and they're going, it's all right, we've got another 6, 7, 8, 9 months to go of this bull market, and then things will be over, and then things will start to sort of sell off. No, I think things are getting a lot more compact with that, and I don't think it's going to be long before. I think a recession at this point is almost a guarantee. I don't know your thoughts on that.
Well, Powell's been signposting it, hasn't he? If we look at the dot-com, went inverted in 2000. We had recession all the way over here, I think it was. 89, we had a recession in, I think it was early 90, something like that. 2007, 8, inverted here in 2000 and, well, actually inverted in early 2006. We had the recession in late 2007, 2008, right? So the curve inverts and then you get the shit happening after. What this inversion looks like is actually here.
Okay. Yeah. Yeah. But the point that I'm trying to get at with the yield curve inversion is I still think people think that these markets are going to run for the next 16 months or, you know, a little bit of time. I don't think that's likely. I think we're now going into that downtrend that's going to be the precursor potentially to a recession with everything going up.
Yeah, no, I'd agree with you. You know, you just get these really sharp rallies that we see. And, you know, people all get excited at the movement in price while forgetting about the conditions. This is actually something that I said on a comment. I think someone had said to trader EXO, like, where do you see a certain altcoin bottoming out at? And I said back, like, you should focus less on the price and focus more on the conditions in terms of where a bottom should be found. And those conditions are found when the Fed says, okay, that's enough hiking, we need to cut now. That's purely what it is.
You think that's a good bottoming signal? So what you're looking at is sentiment more than price necessarily.
Yeah, absolutely. You know, it's important to focus on the conditions rather than price. You know, if you're an intraday trader, then what you're looking at really when you're doing technical analysis is flow at the end of the day, which is why I think technical analysis should be complemented with order flow if possible. And it's why I think people fail with FX, because there's no order flow to be seen unless you've got an EBS terminal or fast match, something like that. And so, you know, I think really the focus should be, when you're looking at a regime change, is on the conditions rather than prices.
Yeah. So moving forwards, you know, things are still very much in motion. The conditions are there for more downside, and what's going to change that really is looking at the Fed and looking at a monetary shift, and a reverse of what they're currently doing, and that doesn't seem to be the case, or certainly in the near future. And where are you looking at for crypto? You're looking at the cryptocurrency markets right now in relation to everything and kind of going, well, huge correlation between the equity market. Equity markets don't look great. That's signaling more downside for crypto. Maybe give us some of your price points of where you think this will get to, because I don't think there's any reason we don't trade under 30K in the next 3-4 months, something like that.
Well, yeah, I mean, you can see my my alerts, my 2 alerts that I've got set up here. So one is at let's say 32 and where is it? Let's say 34, sorry. One's at 34. And then the other one is down at 28-ish.
Okay, and when you say you've got alerts, are these areas you'd be a buyer, or are these areas that you're just watching for?
These are areas that I'm watching for, obviously, because I'm not always looking at crypto. I'm more looking at ES, but because crypto has got a lot of leverage in it, and because it's a higher beta than stocks, you tend to find that potentially it might react to certain conditions faster than equities. You know, it's easier for market makers to pull their bids in crypto, for example, than it is in equities, because it's a smaller market by a long margin. And so, you know, I'm really looking there as to an indicator as well of what people are thinking. That's what I think of a lot, especially retail, because crypto obviously has massive retail participation in it. And if you can get some clues as to what retail are thinking, whether they've capitulated, whether, you know, they're scared, whether price is behaving at the lows in the way that you'd expect, then you can extrapolate that information into, you know, what it looks like for other markets. What might people be thinking? And so really that's what I use those alerts for in terms of crypto.
Can we talk about your 28K tweet? Was that a sentiment test? Can you talk a little bit about that?
Yeah, so, you know, I don't mind eating shit from people if, you know, they want to say I'm wrong or anything like this. The reason why I say, look, it's a fucking obvious level to look at, right? 28K. It's right underneath all of these lows here. You know, if people are getting angry about that, about me saying something inflammatory, purely so I can find some info about how people are feeling, then whatever, that's fantastic. I take that and I, analyze it. But really, when I say these things, I mean like half of the range. Like you can see here, I've got 34K. That's really where I think it would go. Having a 10K move, or over 10K at the time, in a week is pretty ridiculous at the end of the day.
Of course. Yeah, of course.
Right.
Of course.
But to get people to get actual reactions as to how people are feeling, and seeing how many people agree with you, how many disagree, whether people are like, no, I think we can go to 19K, blah, blah, blah. Do you see what I mean? It just builds a picture. Because if I were to say, oh yeah, do you think we're going to go to 28K? If people don't give a fuck, they'll just give their opinion nicely. I don't want that. I want people to feel something about the tweet. I want people to think that I'm an absolute bastard, or to think that I'm right. Do you see what I mean? And then you get a good gauge of
And what did you get from that? What would you say you got from that?
So in the first 2-3 hours, I got 19 to I think it was 21 in the end, actually, people calling me basically a fucking idiot, which is good. That's what you want. And then people dissecting things by price levels, rather than looking at the Fed tightening, or the Fed doing any of their shenanigans. It gave me the sort of comfort that it is a bear market. We know that. Look where we are off the highs, and I think that it can go lower. In a week, ridiculous. Like, just dumb. That might happen in an altcoin, not in Bitcoin. Like, it just won't happen. But yeah, that's pretty much what it gave me at the time. Just the ability to see that it was actually less bearish than I thought. And if you were to skew the replies.
Okay. Yeah. Because I'm noticing that there's more and more people sort of turning to the dark side, so to speak, turning to the more bearish outlook. But I still think the majority, or certainly the retail sentiment side of things, and I'm retail as well, is still very much taking 2021's mentality into 2022. They're still very much looking for this blow off top. I was a big follower of the Bitcoin 4-year cycle theory. I think the entire game's changed for crypto. And you've seen this, and we all wanted institutions. We've got those institutions, and that's what's driving this market right now. And it's when they choose to get back on board. And retail sentiment can be a huge indicator of just where we are in a how much lower have we got to go? Well, if you've got people saying that it's 30K, the chances are it's probably going to go a little bit lower. If you've got people saying that it's 20K, well, it could be somewhere between your 30 and 20K. So it's you've clearly took a lot from that tweet. Anything you want to touch on maybe moving forward? What are you looking at for markets moving forward? We spoke about the data that we've got coming out today for the labor market. We've got the CPI. Good labor market, just to recap, you said would be actually detrimental for the equity market and markets across the board. And high CPI number, which I'm expecting. Are you expecting that, by the way? A higher CPI number, I should say. Sorry.
Yeah. I don't think it will be necessary. I mean, the last two have pretty much been in line. I don't necessarily think it's going to be a beat, but this is the problem when looking at data as well, especially when you're looking at it from a policy perspective, is that it might not beat, but it's still bad for people having high inflation. Inflation up at what, 7.5 to 8%. It's bad for people. We think of it as traders from, okay, if it doesn't beat, then it's dovish. But that's not the case, because at the end of the day, the Fed is trying to rectify issues in the real economy, right? So that's why I actually prefer to look at previous in times like this, not the expected, because I think that matters. It shows you a picture over a certain period of time as to where inflation's headed, and then obviously how the Fed would or should react. So I don't necessarily think it's going to beat expectations. They've been quite accurate, but I do think it's bad for people, and so the Fed will act.
Yeah, I don't mean to put you on the spot here. What are expectations moving into this meeting? Do you know what that is?
CPI May expectations. Let's say
So they've got 8.8 there.
that was for April. Sorry, yeah, no, that you're bang on. There's no consensus out yet, actually.
Wow.
But the forecast is 8.8. Yeah, you're right.
Okay.
That's trading economics forecast.
What do you think inflation's close to? I know it's a very hard call to make, and a call that's got so many variables in it that no one can really know for certain. Do you think inflation is looking like it may be starting to peak out? What's your thoughts on that? Do you think that inflation is sort of running its course at this point, or do you think we've still got quite a bit to go?
Well, people keep saying it. I do think we're up at the upper bound now, and the Fed is indeed increasing rates. Probably the best indicator is at the housing market, purely because of the wealth effect from the housing market. So we've been talking about housing a lot recently. So I wrote an article saying my head isn't turning away from the housing market. I had some links to China in it and what's happened in China. I think Tim, my colleague, he wrote one the other day, which I can show you. Where are we, Tim? Oh, this makes sense.
I love the thumbnails there.
Oh no, we're not bad at it. So this is the one. Housing is the key to slowing inflation. And I can drop you this link. I'll also do an offer for anyone that wants to join Macrodesiac as well, by the way.
Yeah, we'll leave all your links, all your socials, everything. If you're wondering what David's actually looking at and referencing here, it's his own website, and of course you've got a newsletter and a members kind of group that people can join if they want to for some of the latest and hottest sort of macro picks.
Yeah, so this is the free note, and this one that I wrote is the paid one. Because it gives like actionable stuff. So that one was about looking at a house builders ETF. But basically, this is what it comes down to. If you don't call the housing market, you don't call inflation, because if you consider what housing is, at the end of the day, it's security. You know, it's probably the number one vehicle that people can lever up on to obtain credit. You know, you can go to a bank and say, I want to refinance my house and get, you know, however much out of it, 50K, 100K, and then go and do whatever the fuck you want with that money. So this is being able to decrease house prices means that people are going to do that less. And so, you know, that's what our thinking is here, is that if the Fed is able to cool house prices, then they're going to cool inflation at the end of the day.
I think there are signs of that as well. I was looking at mortgage applications, and I think they're dropping off massively, certainly in the US.
Massively.
To the tune of, I can't remember, in a week I think it was down like 70+% in terms of applications.
It was down 62%.
That's it. We're looking at the same thing. Now that's an indication that people are kind of somewhat worried, and that's when you talk about housing. One reason that it's so crucial to markets is because it's a huge supplier of liquidity in many ways. You know, when you talk about people refinancing and remortgaging and stuff like that, a lot of time that goes into markets, a lot of time that goes into the economy and everything. And if that slows down, that's taking away a lot of the sort of momentum that's there. So you think housing is key. And what's your outlook for the housing market, just very quickly?
Down.
Fantastic answer.
So in this one, I'll show you this article. Basically what we were showing here, I believe, was, so in white, you've got the house builders ETF, which is XHB, I believe.
Okay.
And then you've got Case-Shiller year-on-year home prices.
Yes.
So that basically is, you know, house prices at the end of the day. You can see how tightly it tracks in terms of correlation, coefficient. You can see how tightly the housing market tracks house prices. Basically, there was a bit of a discrepancy here in terms of the ETF and the house prices, but we were facing a downturn then, so it's likely that, you know, this would have dropped off. You could see that it converged as well. But basically, because obviously the house builders ETF is exchange traded, and the house price index is reported like once a month, you can see that obviously the house builders ETF is going to have a lead time on the data. So what we're looking at here is XHB falling faster than the house prices could be reported. Now let's recreate this chart. I've not recreated this chart since I have done that one there. So let's see if that actually holds true. So if we type in, oh, come on, XHB, so that's the home builders ETF. And then we chuck over Case-Shiller house prices, year on year, new price scale. They're not currently dropped off yet, but I would expect them to, because basically house builders only tend to build in a rising market.
Yep.
So, you know, I'd expect that this is close to the top for house prices up here. And, you know, if house builders have become less attractive to buy, it means that, you know, they're probably facing higher margins, which is very true in terms of the building materials, cost of building materials. And that means that the margin on actually making more houses is not sufficient, because demand's probably not there. And so, yeah, you know, I expect that to be the top in house prices.
And this is something to watch, because of course, if the housing market slides, everything else is likely to go with it, in a similar sort of way that, you know, crypto is very correlated to your equity market now. They're all very correlated as one of the huge drivers of liquidity to the housing market. So just a final note then, David, on things that you're sort of expecting moving forwards. It's not the best outlook. I mean, don't get me wrong, there's some amazing opportunities that I think are going to present themselves. But over the next sort of 3 to 6 months, what are you expecting?
Well, the Fed's going to start to reach peak pricing in of interest rate hikes, I think, over the next 3 to 6 months, because it's likely that they will see data deteriorate and will probably see that demand come down. So I think the market is going to, well, the market has overshot itself in terms of, you know, how long they'll hike for. I don't see them hiking beyond 2022, basically, especially with QT coming into the picture as well. It's a seller's market at the end of the day. You don't want to stay long for too long if you do get involved in a bit of a bounce, because it's very much a sell the rip type thing. And yeah, until those, you know, until the Fed turns more dovish, I'm not going to say to really get long anything. When the Fed does turn dovish, I'll be back on saying, you know, max out everything and buy Bitcoin or Ethereum, basically.
Yep, that's brilliant, David. It's always an absolute pleasure to have you on, mate. I've really enjoyed it, and you've got some key takeaways there to watch. I mean, the Apple one is something I'm personally going to be switched on to. There's going to be a link to all of David's socials and, of course, Macrodesiac, where you can find both his free newsletter and his paid newsletter in the description. Thank you very much for coming on, David. It's always a pleasure.
Cheers, mate. Thank you for having me.